Not all rate cuts are created equally. Not all delays are either. Is this a healthy delay?
Well, good morning. Thank you for having me. So far, it seems like a healthy delay because it's supported by resilient growth. I think the concern that we have is that the longer that these rate cuts are postponed, the more credence we get to the possibility of rate hikes. And that uncertainty around monetary policy is just not a great backdrop for credit. It's not a great backdrop for M&A or deal making. It's clarity on the macro that we need, not necessarily a favorable macro in terms of rate reductions. It's really that clarity that's key, so that's why we're focused on that.
What we've had so far this year has been a pretty resilient credit market in the face of a repricing of interest rates higher. What's behind that resilience, if you could go through the list for us?
Sure. So a couple of things. One is resilient growth, and I think that's been particularly important for speculative grade issuers that are more growth sensitive. So IG issuers have more of a cushion. They can handle a downturn in growth. High yield and leverage loan issuers, not the same defensiveness there. So growth is number one. Two is the yield backdrop. We've talked about this before. Spreads are tight, but yields are really attractive in the context of the post-financial crisis era. So if you're an insurance company, a pension, an endowment, you're looking for yield, it's been an attractive area to deploy capital into credit. But it's not been resilient across the board. I heard your earlier segment where you were talking about kind of triple Cs. It is true that triple Cs outperformed on a total return basis, but that's largely been driven by rates because triple Cs are less duration sensitive than, say, double Bs, that high end of the high yield spectrum. If you isolate credit spreads, which I would argue is actually the true measure of credit risk, triple Cs have been lagging. And so if you take the index level spread of high yield, 299, very tight, that would suggest that triple Cs should actually be somewhere around 600. They're around 720 in spread. So triple Cs on a spread measure, which I believe, again, is isolating that credit risk, has not kept pace with the tightening overall. That's also true in the loan market where triple Cs have lagged. So the market is efficient in telling you that not all of these companies can navigate high for longer the same way.